Understanding stock fundamentals is essential for making informed investment decisions. When evaluating stocks, three fundamental metrics are particularly important: earnings per share, the price to earnings ratio, and revenue growth. These indicators provide crucial insights into a company's financial performance. Earnings per share, or EPS, measures a company's profitability on a per share basis. It's calculated by dividing net income minus preferred dividends by the number of outstanding shares. A consistently growing EPS, as shown in this chart, often signals a healthy company with improving profitability. Notice how, despite a small dip in 2020, the overall trend shows strong growth from 2018 to 2023. When analyzing EPS, look for consistent growth trends. A declining EPS may signal underlying problems. Always compare a company's EPS with its industry peers for proper context. The price to earnings, or PE ratio, compares a company's stock price to its earnings per share. It indicates how much investors are willing to pay for each dollar of earnings. PE ratios vary significantly across industries. Technology companies typically have higher PE ratios, reflecting expectations of future growth. Energy and financial companies often have lower PE ratios. A high PE ratio might indicate that a stock is overvalued or that investors expect high future growth. A low PE could suggest undervaluation or concerns about the company's future. It's crucial to compare PE ratios within the same industry for meaningful analysis. Revenue growth measures how quickly a company's sales are increasing over time. Strong and consistent revenue growth is often a sign of a healthy, expanding business. This chart shows quarterly revenue growth for a sample company. Notice how revenue has increased consistently quarter over quarter, with particularly strong year-over-year growth in the later periods. When analyzing revenue growth, look for consistency and acceleration. Accelerating growth may signal new business opportunities, while slowing growth might require deeper investigation into market conditions or competitive challenges. These fundamental metrics work together to provide a comprehensive picture of a company's financial health. When evaluating stocks, use multiple metrics for a complete analysis. Always compare against industry benchmarks and examine trends over multiple periods. These fundamentals form the foundation for more advanced analysis and help investors make informed decisions based on a company's financial performance. To properly analyze a company, you need to understand its financial statements. There are three primary financial statements that investors should carefully examine. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It follows a fundamental equation: assets equal liabilities plus equity. By analyzing the balance sheet, you can assess a company's liquidity, solvency, and financial stability. The income statement reveals the company's profitability over a specific period. It starts with revenue, subtracts various expenses, and ultimately shows net income. By analyzing the income statement, you can evaluate operational efficiency and profitability trends. The cash flow statement tracks how cash moves in and out of the business. It's divided into three sections: operating activities, which show cash from core business operations; investing activities, which show cash used for purchasing assets or generated from selling assets; and financing activities, which show cash from debt and equity transactions. Free cash flow is a critical metric derived from the cash flow statement, showing the cash a company generates after accounting for capital expenditures. When analyzing financial statements, it's crucial to look for trends over multiple periods, not just a single snapshot. Track key metrics like revenue, profit, and debt levels over multiple quarters or years. Increasing revenue is generally positive. Growing profits indicate improving operational efficiency, while rising debt requires careful analysis of the company's strategy and ability to service that debt. When analyzing financial statements, watch for these red flags that might indicate future problems. Be concerned if revenue is declining over multiple periods, especially if the industry is growing. Watch for increasing debt-to-equity ratios, which could signal declining financial stability. Negative free cash flow without strategic justification may indicate operational issues. If accounts receivable grow faster than revenue, the company might be using aggressive sales tactics or having collection problems. Finally, look for inconsistencies between different financial statements, which could indicate accounting irregularities. By thoroughly analyzing all three financial statements and watching for concerning trends, you'll gain deeper insights into a company's true financial health. A company's leadership significantly impacts its performance and long-term prospects. Evaluating management quality is a critical component of thorough stock analysis. Strong leadership can drive a company forward, while weak management can undermine even the best business models. When evaluating management quality, focus on these key factors: experience and background, track record of success, strategic vision, capital allocation decisions, transparency in communications, and insider ownership levels. Let's explore each of these factors in more depth to see how they provide insights into management quality. Capital allocation is one of management's most critical responsibilities. Evaluate how they distribute company resources among growth investments, stock buybacks, dividends, and debt reduction. Look for positive signals like consistent investment in growth opportunities and stock buybacks when shares are undervalued. Be cautious of warning signs like excessive executive compensation or buybacks at peak valuations. Earnings calls and public communications provide valuable insights into management's transparency and honesty. Study how executives respond to difficult questions and whether they're forthcoming about challenges. When analyzing earnings calls, pay attention to how management addresses challenges, whether their explanations remain consistent over time, and if they're willing to acknowledge mistakes. Look for detailed forward guidance and clear answers to analyst questions. Insider ownership levels can indicate management's confidence in the company's future. Executives with significant personal investment are more aligned with shareholder interests. Generally, high insider ownership signals confidence in the company's prospects. Recent buying activity from executives is typically a positive sign, while consistent selling may raise concerns. However, always consider the context and company lifecycle stage. Remember, management quality is a critical factor in company performance. A thorough evaluation of leadership can help you identify companies with the right team to drive long-term success. Competitive advantage assessment is critical for evaluating a company's long-term potential. An economic moat is a sustainable competitive advantage that protects a company from competitors, much like a castle moat provides defense. Companies can establish competitive advantages through 5 main types of economic moats. Brand power allows companies like Apple to charge premium prices due to strong consumer loyalty. Network effects strengthen platforms like Facebook, where value increases with each additional user. High switching costs lock customers into enterprise software systems, creating stable revenue streams. Cost advantages allow companies like Walmart to undercut competitors through economies of scale. Intellectual property protections, like pharmaceutical patents, create temporary monopolies on unique products. Market share trends reveal the strength of a company's competitive advantage. Companies with strong moats tend to gain or maintain market share over time. Companies with strong competitive advantages typically show growing or stable market share. In contrast, companies with weak or eroding moats often experience declining market share as competitors capture their business. Companies with sustainable competitive advantages typically maintain higher profit margins than their peers. Strong economic moats often translate to operating margins well above the industry average, creating significant shareholder value. Even the strongest competitive advantages face potential threats that investors must evaluate. Technological disruption can rapidly erode existing business models and competitive positions. Regulatory changes may remove protective barriers or increase competition in previously protected markets. Intensifying competition, especially from well-funded new entrants, can pressure margins and market share. Shifting consumer preferences can diminish brand value and reduce switching costs. When assessing a company's competitive advantage, investors should ask these key questions. Is the advantage sustainable for at least 10 years? Are margins consistently above industry average? Is market share stable or increasing? Can the company withstand disruption? And does pricing power remain strong during downturns? Remember, companies with sustainable competitive advantages typically deliver superior long-term investment returns. Industry analysis is critical for understanding a company's competitive environment. Every industry goes through a life cycle of introduction, growth, maturity, and eventually decline. Companies in growing industries typically offer better investment potential than those in declining sectors. When analyzing an investment, identify which life cycle stage the industry is in. Once you understand the industry's life cycle stage, you should examine the company's market position. Market share and positioning reveal how a company stacks up against competitors. Companies with larger market share often benefit from economies of scale, brand recognition, and pricing power. Look for companies with dominant market positions or those with rapidly growing share in expanding markets. Now let's examine competitive intensity using Porter's Five Forces framework. Porter's Five Forces framework helps assess the competitive intensity and attractiveness of an industry. The five forces include threat of new entrants, bargaining power of suppliers, threat of substitutes, bargaining power of buyers, and competitive rivalry. When analyzing a company, assess each of these forces. Industries with weak competitive forces often offer better investment opportunities. Finally, let's examine how industry cyclicality affects investment returns. Industries respond differently to economic cycles. Economic cycles alternate between periods of expansion and recession. Cyclical industries like manufacturing and travel are highly sensitive to economic changes, while defensive industries like utilities and healthcare tend to remain stable. During economic downturns, defensive industries outperform, while cyclical industries tend to outperform during expansions. Timing your investments to align with these cyclical patterns can significantly improve returns. Understanding these industry dynamics will help you make more informed investment decisions. Next, we'll evaluate a company's growth prospects and potential catalysts. To assess a company's future growth potential, we need to examine four key areas. First, analyze the addressable market size. A large untapped market provides room for expansion. Second, evaluate the product pipeline. Strong upcoming products can drive future revenues. Third, consider expansion plans into new geographies or product categories. Finally, assess innovation capabilities through R&D investment and successful new product development. Next, let's identify specific catalysts that could drive stock appreciation. New product launches can significantly boost revenues, like when tech companies release next-generation devices. Geographic expansion into untapped markets creates new revenue streams. Industry tailwinds, such as growing renewable energy demand, can lift an entire sector. Operational improvements, like cost-cutting initiatives, can enhance profitability even without revenue growth. When evaluating growth, compare historical performance with management's future projections. Here we see a company's historical growth rates from 2020 through 2023. For 2024, management projects an 18% growth rate, significantly higher than their historical performance. Be wary of companies projecting dramatic increases without clear justification. This requires thorough investigation of growth catalysts. Finally, consider whether a company's growth is organic or primarily through acquisitions. Organic growth comes from internal development and expansion, while acquisition growth involves buying other companies. While acquisitions can accelerate growth rates, they typically require higher upfront investments. Importantly, acquisition-based growth carries integration risks that can undermine expected synergies. Cultural differences between acquired companies can also present challenges to maintaining performance. Always investigate the source of a company's growth to assess its long-term sustainability. After evaluating growth prospects, we're ready to examine valuation metrics in the next section. To properly value a company, we need to look beyond the basic price-to-earnings ratio. Let's examine multiple valuation metrics that provide a more comprehensive picture of a company's worth. Let's begin with the price to sales ratio, which divides a company's market cap by its annual revenue. PS ratio is particularly useful for comparing companies that aren't yet profitable. Notice how technology companies typically have higher PS ratios than retail companies, reflecting their higher growth potential and margins. Moving on to the price to book ratio. PB compares a stock's market value to its book value. Asset-heavy businesses like banks often have lower PB ratios, while asset-light tech firms can have much higher ratios. Enterprise value to EBITDA is a more comprehensive ratio that accounts for a company's debt levels. Unlike PE, EBITDA is less influenced by capital structure and accounting decisions, making it better for comparing companies with different debt levels. Discounted cash flow analysis is a more complex but thorough valuation method. DCF involves projecting future cash flows and discounting them to present value, along with a terminal value that represents the business's worth beyond the projection period. Here's a simplified example showing yearly cash flows and a terminal value, resulting in an intrinsic value calculation. It's important to understand that valuation standards vary significantly across industries. Software companies typically trade at higher multiples than retailers or banks due to higher growth potential and lower capital requirements. Finally, when considering valuations, we must account for growth rates. This is where the PEG ratio becomes valuable. The PEG ratio adjusts PE for the company's growth rate, helping identify situations where a high PE might actually represent good value if growth is strong enough. Company C has the highest PE ratio but is potentially undervalued due to its exceptional growth rate, resulting in a PG ratio below 1. Remember that no single metric tells the complete story. Always use multiple valuation approaches and consider qualitative factors alongside the numbers. By comparing these metrics to industry peers, historical averages, and the broader market, you'll develop a more nuanced understanding of a company's true value. Technical analysis helps determine when to buy, complementing fundamental analysis, which identifies what to buy. Let's start with price trends, which form the foundation of technical analysis. Price charts reveal patterns that can signal future price movements. Trading volume is another crucial indicator. High volume confirms trend strength, while low volume may signal weakness. Support and resistance levels are price points where a stock historically reverses. Support acts as a floor, while resistance acts as a ceiling. Moving averages smooth out price action to identify trends. When a shorter-term moving average crosses above a longer-term one, it may signal a buying opportunity. Technical analysis helps identify optimal entry points where multiple indicators align with your fundamental thesis about a stock's value. Technical analysis also helps set appropriate stop-loss levels to manage risk. These are predetermined price points at which you'll sell to limit potential losses. Remember, technical analysis works best as a complement to fundamental analysis, not a replacement. The combination of strong fundamentals and favorable technical patterns often provides the best investment opportunities.